Again, I would love to welcome you to yet another episode of Pesa Talk. Today, we are going to look at the different types of collective investment schemes that we have on our market in Uganda. So, there are different types of unit trusts. Unfortunately, for most Ugandans, a unit trust is a unit trust. Yet again, we need to understand why there are different types of unit trusts and what they are meant to do. So, if you're buying a unit trust, you need to consider what it is that you are going to be getting at the end of the day. So in terms of the different types of unit trusts that we have, just a recap, we have the money market fund, we have the balanced funds, we have equity funds, and we have the fixed income money market fund. So if we look at the money market funds, what they try to solve? These ones provide a safe place for you to park your money while you're earning higher returns than a savings account. So you're moving your money from a savings account to a money market fund, you're going to be earning a little bit more than what you'd be earning on your savings account. So these are ideal for people who are looking at short-term goals, emergency funds, and low-risk investors. So if you fall under that category, this is a fund for you. Where they invest, most of these invest into treasury bills, they do commercial paper, this is short-term and corporate bonds, they do fixed deposit in the banks, they do low-risk government securities. So these invest in short-term government securities. So if you're looking at bonds, short-term, 2 years, 3 years, 4 years, because people need liquidity. So they are low-risk, highly liquid, they have stable returns. And averagely on our market, the returns range between 9 to 10 to 12 to 11 for different fund managers. For the entity that I work for, we average on an average of 11.7. The second are balanced funds. So balanced funds are for investors who have a bit of an appetite on risk. So they are ideal for medium to long-term investors who are diversifying, who want to diversify into one fund. So you're diversifying, but you're in one fund, but it's diversified. So you get to have a bit of an investment into the bonds. You get to have a bit of an investment into the equities, and that is stock. So your investment is then a mixture of equities, stock, a mixture of fixed income, that is the bonds, and sometimes money market. So you have investments in each of these, and really this one aims to provide both moderate growth and income because of the amount of return that you're looking at. So if you look at its framework, it has moderate risk. Because of the moderate returns it's giving you, it's diversified in terms of exposure. You go into different markets in one fund. So you have your 1 million, part of it is invested in stocks, part of it is invested in bonds, part of it is in the money market fund. So this one really tries to look at you achieving your long-term growth objectives. So the third fund that we then have on our market are the equity funds. So equity funds, these ones target capital growth through the stock market. These ones purely take you to the stock market, and stock market is where you're buying shares, you're buying stock on the stock exchange. So you have a fund that is backed by what you call the stock market. So the fund entirely is very highly volatile because of how the stock market keeps moving. So it's volatile, and it also has potential for higher returns compared to the other. And it's best for long-term investors. So investors who can tolerate high volatility and aspire to get potential higher returns should be the investors who are investing in the equity fund. So a few of the fund managers have this equity fund, and where these investors have mentioned they invest on the listed stock exchange. For example, in Uganda, they invest in the regional markets. For example, the Kenya Stock Exchange. They are growth oriented backed investments, and here you're looking at high risk, high return potential, and long-term wealth management. The last for today is the fixed income money market funds. So the fixed income funds, these ones invest, most of the investments are in government security and corporate bonds. They they look at other long-term debt instruments that they can invest in as alternative investments. They are low to medium risk. They are ideal for investors that want steady and predictable income. So if you're in a space whereby you want to have an indication of how much you're earning, the company that I work for, of course, has a product like this, the fixed income money market fund. It gives you an indication of stable and steady predictable returns. It's able to pay out to you on a monthly basis. It returns slightly higher because of its accumulation of allocation into the government bonds and corporate bonds. So you look at its low risk to medium risk. It gives you regular income, and it has capital preservation mechanism. So if you're investing then in the fixed income money market fund, your need cannot be the same as someone who's in the equity fund. Your profile cannot be the same as someone who is in the balanced fund. Your profile cannot be the same as a person who is in the money market fund. So some of the benefits that we look at for the different funds that we've spoken about today is, you look at each of these unit trusts. When you look at the way they are structured, the four of them, they give you diversification into different markets. They give you convenience. Most of them are 24 hours away call back to your bank. They give you an economy of scale where you'd have your 15 million and take it to a bank directly for a fixed deposit, and you're negotiating in the ranges of 2 and 3. You're going to see yourself earning in the averages of 10 to 12, which is very competitive. These unit trusts, majority of them can satisfy your liquidity needs because you can easily convert them back into cash. They are easy for you to access. They're just a message, an email, an app away for you to call back. There's a lot. I mentioned we have 20 licensed unit trust schemes. So in terms of choice, you have a variety of choice. I've just spoken to 4 different unit trusts, so you can choose from any of those 4 and see which one fits your profile. They are there's a regulatory framework around them, so there's regulatory protection for you as an investor. They are not the capital chicken of this world. And then currently, the sweetener is that they are tax exempt. As we speak, URA doesn't tax unit trust. So from me, again, as the host of Pesa Talk, I would love to say unit trusts are just one of those very many different investment options for you to consider. And mine is just to make you aware of what they are, what we have on the market, the different types, their benefits, and what they're supposed to actually do to you as an investor. So again, until next time, we shall be discussing further into what collective investment schemes are, and we should be able to look at the sweetener that we call the power of compounding. Thank you for being good viewers. See you. Bye-bye.